Hey there, it's Jared Hamilton with the Hamilton Group at Cherry Creek Mortgage. Welcome to another edition of Java with Jared. Happy Friday. Hope you guys are doing fantastic. Well, it was a pretty rough week in mortgage rates. We've seen over just this last week almost a 200 basis point deterioration in rates, which translates almost to about 0.25%. So rates really got hammered this week. And the prime culprit is just because overseas yields on bonds are rising, and that's overflowing here to our market. It started off the week bad, and it just continued throughout the rest of this week. And we were hoping to get maybe a little bit of relief here with the jobs number. That was a big economic piece of information that was being released into the market, and it really didn't help. We're actually seeing interest rates continue to deteriorate a little bit here, even on these jobs numbers. And here's what happened. Expectations were for about 224,000 jobs added to the economy. The actual number came in at 280,000 jobs added to the economy. Now, the unemployment rate, which was at 5.4%, actually went up to 5.5%. And the reason that that happened is because about 390,000 people re-entered the workforce. And we've talked about the labor force participation rate. That's, how many people who could work are actually working. And if you're not looking for a job, you're not counting on the unemployment numbers. So more people came in looking for a job. And even though more jobs were added to the economy than what was expected, the unemployment rate actually went up a little bit because there's just more people looking. Now, as I've talked about here over the last few weeks, we've transitioned into what I think is going to be, at least for a while, a rising interest rate environment. And that's, continuing to play out. We passed that important 200-day moving average, and we're well beneath that level of support. And so we're just going to see a period of high volatility and actually probably rising interest rates. Now, I don't think interest rates are going to go through the roof or anything like that because the economy really isn't that strong yet. But it's just going to be a period where, we've seen incredibly low interest rates, and we're at levels that we haven't seen for the worst levels of the year, and levels that we haven't seen since September of last year. So while I don't think we're not looking at, ultimately 5% interest rates here this year, we're still going to be maybe in the low fours and going to have a whole lot of volatility. So always tell your clients to lock when we see these moments of opportunity, because rates just won't just go up on a line. There are going to be good days, there are going to be bad days, so we need to lock on those good days, because I think that we are going to be, unless we see some economic data that changes it, in an environment where rates are moving up, and we're just continuing to see that happen. But we'll always keep you informed. Hopefully we'll find here a bottom and get some stability here and maybe a little bit of a relief rally, because we've lost a lot of ground in a short period of time, and usually we'll see things bounce back a little bit. But we'll always keep you informed. I hope you're having a good week. And if you're working this weekend, so are we. If you ever have any questions, please give me a call. Thanks for joining me with Java with Jared, and we'll talk to you soon. Bye-bye.